Greetings, and welcome back to the Rose Bros podcast. This episode, we are joined by Ryan Bushell, President and Portfolio Manager at Newhaven Asset Management. Ryan is a regular contributor to the Globe and Mail, Reuters, and Bloomberg's Canadian divisions. He's been a regular guest on several BNN programs, including Market Call since 2011, and is a repeat guest on Bloomberg TV Canada. Ryan has a Bachelor of Management and Organizational Studies specializing in finance from the University of Western Ontario and is a member of the CFA Society Toronto. We sat down for a smooth cup of Rose Bros coffee and discussed how to build a portfolio, inflation, backwards energy policy, consistent returns, detecting skin in the game, investing in cryptocurrencies, and a lot more. Enjoy. Also, this podcast is sponsored by headracingcanada.com. Looking for high-performance ski gear this winter? In partnership with four-time Olympian Manny Osborne Parody, headracingcanada.com is offering the lowest prices possible through its online storefront by passing brick-and-mortar savings on to customers. Check out headracingcanada.com for more info and get your high-performance ski gear for the upcoming season. Well, we can get going if you're good.
Ready to go.
Ryan Bushell, thank you very much for doing this.
Thanks for having me. I'm looking forward to it.
For anyone listening, you are the President and Portfolio Manager at Newhaven Asset Management. What is Newhaven Asset Management?
So it's a small, individual-focused investment firm. My partner purchased it in 2006. It was originally started, this is kind of boring backstory, but it was originally started as the investment arm of a life insurance company, a bespoke kind of large policy life insurance company, and those people that buy those types of policies would also sometimes be investment management. But they weren't focused on the investment management. The insurance side was growing. The investment side was, they had a registration, they were up and running, but they weren't growing it. So my partner purchased it sort of in a semi-retirement phase for him. I think he was about 55. And he kind of kept it, he brought in his friends and clients and kind of kept it status quo. 10 years went by. So 2016 is when we started talking. He was looking for someone to succeed him in the business and keep it moving forward. I don't think he expected a partner so quickly. I think he was trying to develop one. And interestingly, it was just a LinkedIn job posting that I was kind of frustrated at my previous employer. And it was, one of those things like 10 jobs for you today. And I clicked on it. And it was through a recruiter, so I didn't meet him directly. And they said, well, we think what you're looking for is actually what he's looking for. And it turned out to be a good match. We spoke for about a year and a half before, I fully committed. I had a 1-year-old at the time. And so it was a bit scary to leave. I had my previous job. I was there for 12 years, I think in total, 13 by the time I left. So I built up a lot of credibility and had a good, but things were not good where I was, unfortunately, taken over by another company, them not understanding exactly what we did, kind of trying to force some things down onto us that weren't good for the business, in my view anyways. The timing ended up being pretty good. It was scary, like I said to you earlier, I never really planned on being an entrepreneur. I always thought I'd just be a good soldier, a good lieutenant in a larger business. But now that it's been thrust upon me, I'm enjoying it because it means that the company reflects your own values and in a way that is hopefully visible to the clients and to other people who the business has visibility to through things like this, etc. So it's exciting to know kind of where it can go, because I look at it that I'm 5 years now into, that was 2018, I firmly joined. So 5 years into hopefully a 30-year plan, God willing.
You're also pretty young, which is awesome for it to be an entrepreneur at a wealth management company that in an industry that seems to reward age and experience. That's awesome.
Yeah, it's a fair point. It's funny. Like the company I started with was called Leon Fraser. It's still around. It's owned by Canadian Western Bank now. When I was there, the people that ran the firm, so Leon Fraser himself started that firm in 1939. His son George joined in 1947. And George was there, and I sat in his office the first day. I walked in the doors, and his name on the door. And, he made it kind of very simple for me right off the bat. He said, if you want to make $1 million a year, there's the door. Like, there's plenty of doors in this area where you can try try to, pursue that. But if you want a job where you kind of do good work for your clients and you grow alongside them and your motivations are in line with their motivations and you learn something new every day, then this is a good place for you. And I didn't really know what that meant at the time. Like, I'm from small town farming country, Ontario. The people, there's the 4 bank branches in my town, but there's not high finance. I didn't know anybody's dad that did this. I didn't know anybody's uncle. My parents both worked government jobs, so they had pensions. They didn't have investments really of their own. There was be sort of the thing where like I buy RSPs, and like that's, they were really buying mutual funds, but they didn't even know what a mutual fund was. They just, I put it in my RSP, et cetera. So that's sort of the place from which I started, right? And so when you think about coming into Leon Fraser, it was a whole, I had a summer internship that kind of opened my eyes to finance at Bank of Montreal, but then this was like a whole new world for me. And so I started there, and but the thing about that firm was it was really established and had a long track record. And I went right into 08, 09 and sort of saw the worth and the value in being patient and sticking to things that people need, not what they want. And, we're kind of going back to that now. The last few years has been strange in terms of how people value capital. But at that time it was like, how much money do you make? How much cash is on your bottom line? It didn't matter what your growth was or what your idea was. It was, how can you survive the downturn at that point? So good, valuable experience. And so I always say, like, I look young, and I am young for the industry, but I think old. I kind of joke with my partner about that. He's almost 70 now. And I always say, like, I'm more conservative than you are because you actually had the good times. I never had them. I started off right into a major recession, was taught by someone who went through the Depression. So I always say I'm a little bit less optimistic or less aggressive anyways than most. And so that's kind of done me well in this most recent time as well.
How did you get into investing? Why did you go that direction in the first place?
It's a good question. Like I said, I never really had anybody who, I didn't even really know up until even into university, like what the stock market was, right? Like I understood it conceptually, I guess, like companies trade and the share prices move, but I didn't really understand the structure of, fractional ownerships of corporations and capital structures, how much debt, how much equity, what a PE multiple was, any of that stuff. I didn't, and that's something you don't, I guess certain business programs teach it, but it's not really something that is well covered, and certainly not in my high school. And then even into university, I was in a business program, and there wasn't a ton of insight into, investments as a job, right? So it is something I think most people learn once they're done their undergrad. And so, like I said, I came into this firm and I thought, I had this internship where I did foreign exchange and capital markets, they were big markets. They gave me an understanding of, bid price, ask price, how a market can move based on news, the FX market moving on GDP numbers or employment numbers, et cetera. So that kind of tipped me off to that. But in terms of like investing people's capital, I think where that resonated with me was, again, speaking with George and him saying, like, you just need to do a good job for your clients. You need to buy things people need. You need to rely on good people running good businesses and not get taken off course by fads or frauds, basically, and frauds can be like the FTX thing this past week, or a fraud can just be, a stock that's priced richly that isn't going to live up to those expectations, where the expectations are just higher than the actual business can deliver. So that kind of tipped me off to it. And then it was just kind of one day at a time, head down, learning the business. But what I really enjoyed all along was that thought of like helping someone achieve their goals through investing. And that's been sort of twisted and dragged through the mud by people with, either poor morals or poor motivations or both. But people do need that. Like when I speak to clients coming in, they want help understanding their fund. They want to understand what's going on. They don't want to feel like they're just throwing money into a black box. So that's what really kind of, I guess I developed a love for that as I went along. It wasn't something I sort of decided to do at 22. It was like, I've kind of decided to do that over the last 10 years. And now I feel like I'm actually just getting started in helping people do that. Because I'm just taking on my first clients of the last 5 years that hopefully I have for the next 35 years, right? That I can help them get from 65 to 95 or 55 to 80 or whatever that number is, right? So I always say it's not like if I was just building houses, it'd be like, okay, I finished your house, here's the keys, right? Hope you enjoy it. With the portfolio, it's a lifelong journey for most people. And if you do it right, then hopefully your goal is that the people you get never leave you, right? So I'm just in the process of starting that. And so a lot of it, in terms of the investment side, I've had lots of practice on picking companies and seeing markets play out. But in terms of actually helping people get from, one stage of their life to the next and on to the next, that's something I'm learning as I go and something I really enjoy.
Sort of a steward of capital, almost taking that sort of approach.
Yeah, exactly. And the last few months have kind of shown why that matters, right? There were a lot of people that had capital on paper a year ago that don't have nearly as much capital now. And our portfolios are we had a good year last year, best year I've ever had in my 16 or 17 years actually being accountable for performance. And that's circumstance, right? That's what does the market give you and how much do you do within the market that adds value for their clients. But this year is where I feel like I add a lot more value, where S&P down 15 to 20 depending on the different point this year, NASDAQ down 30. Our portfolios are flat, still generating more dividend income this year than last year. Actually, dividend income that's gone up in line with inflation, 7 or 8%. So they're actually being, first of all, their capital hasn't dropped. Second of all, their income has risen in line with inflation. And so their purchasing power, by and large, relative to peers, is much better. And I haven't even gotten into how badly bonds have done this year, which was to me the big pothole that a lot of people should have seen coming, but just kind of drove right into because of either regulatory or just a static asset mix, et cetera. But for me, it's like, okay, I've kept people whole this year in a year where a lot of people have seen a lot of retrenchment. And for my clients, they always say it's the high net worth space, right? I'm doing the air quotes. But for me, I call it like normal net worth, my clients. If you've got $1 million or so at retirement and you want $75,000-ish a year before tax, to me, that's not high net worth. That's what most people's average person strives for. And so that means that every dollar is important. You can't kind of lose 20% of it overnight and not have it generating any income. So that's why I invest money the way I do. And that's kind of where I came from too. That's my background. Like, I'm not a high flying kind of person, right? It's like, we need to actually make this money work properly for a long period of time in a sustainable way. And that's been difficult over the last, certainly for my whole career, but especially the last 3 or 4 years.
Newhaven is a entrepreneurial activity, and a lot of the best businesses along the same theme are run by people who have money in the game. Have you had to put your own money into the company, or do you invest your own money alongside your clients? How do you make sure your interests are aligned with people you're investing for?
Yeah, definitely. So the great thing about having no preconceptions, I always say, is like, I learned one thing, and luckily I learned a good style of investment management, in my view, for what I want to deliver to people. Again, if you're a teacher's pension plan and you've got, billions of dollars and you're trying to run that money for as a going concern basis for like the next hundreds of years, right, to sustain teachers on an ongoing basis as they come into the program and pension out, right? So that to me is a different investment mandate and calls for different types of investment in the private equity space. And much has been made of their crypto investment in FTX that blew them up. Mm-hmm. They got blown up on them last week. But again, they need to have, understandings and pieces of different investments because their time horizon is so long. For me, again, I look at it and I go, okay, my clients are most of them are in their peak earning years or just after their peak earning years. So they're sort of 40 through 70, say. And so their time horizon is, anywhere from 20 to 50 years, which is very different than, say, an indefinite mandate, let's just call it, for a pension fund or an endowment fund or even a hedge fund where the capital is not going to be used to buy groceries, right? So when it comes to that, my motives are very much along those same lines. And so, like I said, I learned kind of one investment style that does a good job in my view. And I've done the historical testing of my predecessor's results and then mine alongside that for the last 70 years and said, this portfolio had generated income every year. It's had fewer down years than the market. The down years, when they come, are less severe than the market. And so that, to me, gives you that steady path of returns that are trending from bottom left to top right without a big capital drawdown that puts you at risk if you're then drawing from the money when that drawdown happens. So all my money is invested along the very same lines as my clients in the same stocks. I hold them separately managed, just like my clients do. So no funds. I put $250,000 to buy a 15% stake in the company up front on debt versus my home at the time.
That's awesome.
That's mostly, well, it's still in my new mortgage, I guess, but eventually, hopefully, I will get paid off now that the business is transitioned. We did a reorganization last year where I now own 85% of the company and my partner owns 50%, and that was always the plan. And he's been very good about going through that process, been very fair to me. And I've been good to him too, because I've grown the business far beyond what he would have been able to do himself. So all that's good. And you know this, being an entrepreneur yourself, like there's nobody but you, then you first of all, you have to eat your own cooking. And second of all, the company represents your survival as well. So if the company doesn't survive, you have to get another job or get another, find a way to provide for your family. So I couldn't be more aligned, I guess I would say.
One thing I've been thinking about a lot lately is a lot of management teams seem to have skin in the game, but you don't really know whether the shares were just given to them. When you're searching through companies, how do you figure out whether they put their own money up and really sacrificed anything, or the shares were just given to them? Is there a process you go through for that?
It's hard because in a company, it depends on the company, right? So the companies I like most are the ones where it's that founder, manager, exactly, who built the company and has, their life tied into the company. However, with a bigger company, like let's just say an Enbridge, first of all, that company is too big for anyone to own a significant portion of it. And second of all, it doesn't make sense for someone to have, unless they have full kind of control over the business and they're willing to do that. It doesn't really make sense for someone with an entity that big, with regulatory concerns and different things that can then come at that business to have, like I wouldn't suggest that one of my clients do that. So I can't hold a CEO accountable to that either, right? So what I find in the Canadian dividend space is that you see less of that. You see less of the stock-based comp tied to short-term goals. I mean, there's always going to be some of that, right? But in the, it's not like an Elon Musk Tesla thing, right? Where it's like, okay, you're either just betting crazy amounts on share price growth, and so therefore you're motivated to on that side of things more so than necessarily running the business, or the various U.S. companies with just a big stock-based incentive program. The Canadian companies, there's obviously stock-based incentive comp, but the share prices don't, at least in the companies I own, they don't fly around enough to really incent someone to juice the share price, if you know what I mean. So each company is different. A company that I owned, for instance, that I really liked that had a big owner position was AltaGas. So David Cornhill basically started AltaGas, and I don't know if it was the late 90s or the early 2000s. And he was, I remember the company got pretty big when we first bought it in 2013 at my previous firm. And it was I would say the different owners in the Bloomberg ownership registry, right? And it would say, okay, this firm owns whatever it was, 15% of the company or 10% of the company. And it was just his name next. So a lot of times the CEO, even an owner CEO, it'll be a holdco, or it'll just be it won't be in their direct name, but this was in his direct name. It just said David Cornhill owns, whatever it was, 500,000 shares or 5 million shares, whatever the number was. And I remember thinking wow, that's there's not too many companies like that. That's what you'd love to see. But in my business, I'm buying those bigger companies where you're not necessarily going to see that often. And for the bulk of the portfolio, I own some smaller companies, and there I look at that more critically. So I'm not giving you a very good answer here, but it really depends on the situation. And usually a big part of my process is talking to the people that run the company, and you can find out pretty quick. It's funny, you go into these investment meetings And sometimes I'll go in with another PM from another shop. And typically that other PM will be asking what I would call like a smaller picture question, like what happened last quarter? What are you guys seeing for next year? So something that's sort of in the minutia, because they've got their model and they figured out the company and they're looking for what the catalyst is in the short term that's going to move their performance one way or the other, right? Because that's how they're compensated and that's how they're motivated. For me, I'll go into a meeting and say, look, I want to own this company. I like the long-term vision of it. I know that short-term things are going to move around. What do you see in this company for the next 5 years? What do you see in this company for the next 10 years? And that's where you can get an idea pretty quick of, if they've thought about that, and two, if they have like a good answer for that, then that shows you that they're aligned with the long term of the company, because they're thinking more than just how do I get through the next year or the next quarter or what have you. And so I find that to be a useful part of the process. And I remember asking, going back to David Cornhill, I remember asking him that question. He was at the end of a long day of marketing meetings where he had to go into all these different investment shops and talk to them about their strategy and talk to them about their quarter and go through their investment deck. And we went, okay, we like this company. We're starting to buy it. Like, tell us what the future is. I remember him just like lighting up and being like, there's so much opportunity in Western Canada. The infrastructure opportunity we have out there with the resources we have in place, it's going to take decades to develop. And he just went through all and that was, when you get that type of an answer, the short term is going to come and go, but you can then buy in the short term when the company has a misstep on some sort of short-term results, and keep owning it through to see that vision kind of realized. And fewer and fewer people have that ability because their timelines, like I say, get shortened by how they're compensated and how they're motivated.
It seems like maybe it's the nature of the assets in certain companies, like a pipeline company or legacy railroads. You can't go wrong with management, so it doesn't really matter. But there are some management or executives out there that say they have skin in the game and they have shares on paper, but they were given to them. And so it's hard to kind of figure out really what's true.
Yeah, I'll tell you, like the best learning I ever got on this was when George was still alive, and the offer came to buy out Bell Canada from Teachers Pension Plan. I don't know if you remember that, but it basically happened in 2008. Mm-hmm. So the offer, I think, was made in June 2008. Oil was at $140 a barrel. The Lehman Brothers hadn't happened yet. We had Bear Stearns, but we hadn't had the full extent of the subprime mortgage collapse yet. I remember he said, this was like one of my first analyst jobs, because up until that point I was just doing data entry. I was like a year and a half in, I guess. He said, well, you have a cell phone, like analyze the telecom sector. And what about this RIM company and, like all that stuff. And I came back and I said, I wouldn't buy RIM. They don't pay a dividend. They're a one product company. But I said, I would buy Rogers. And this was pre-iPhone. I said, Rogers at the time, the only company in Canada with a GSM network. They're going to be the only company that's able to support the iPhone. This iPhone is going to be big. Like, if you see how many iPods are out there at the time, again, I sound like I'm 100 years old, but it really was only 15 years ago. This is going to be a big deal. And Rogers, their debt levels come down. They're paying a dividend now. And I said I would sell BCE to fund it. BCE has been dead in the water. It's been $28 forever. At the time, it was being managed by Michael Sabia, who I think is now still with the Caisse de Dépôt, but he might be done there as well. And, it's gone nowhere. It's been $28 since the Nortel spin out. There's no point in owning it. It's bureaucratic. And they're falling behind, frankly. They got a copper network for their internet side. They've got, a poor wireless network. So I remember going to George with that thesis. Says, "Yep, I agree with you. I'm buying Rogers," but he's like, "I'm not selling any of my BCE." So I said, "Okay, well, he's the boss, right? What do I know? I'm 24 years old." And so then, like literally a week later, 2 weeks later, not that much later, the takeout offer comes in for Bell Canada, and I walk back into his office and I say, "How did you know?" Like, because the offer was at $40, so $12 up from the $28 level. I said, a pretty big premium, right? Teachers obviously wanted the asset. And I said, this is great. And he said, this isn't great. So what do you mean here? You're going to get $10 in your pocket and you can, he's like, now I have to go find a company that has as much potential long-term as Bell Canada that can pay me that dividend for the next 50 years. Why do you think Teachers wants the asset? And I said, oh, I guess that makes sense. But I said, but it's so bureaucratic and it's been poorly managed. He said something I'll never forget. He said, if the assets are good, the management's temporary. Mm-hmm. So basically, shareholders will not tolerate someone doing a bad job with a good asset for that long. And interestingly, if you look at what happened since, right, the deal falls apart in December. So the shares go back to $22 below because everything got smoked down in January, February, 08, 09, December, January, February, 08, 09. He bought more. He did sell half of his at the $40 level to take some of that money off the deal, but he bought it back in the 23s. And if you look at what's happened since, they've raised their dividend back well through where it was before. They're still paying, more inflation adjusted in line with what they were paying in 08, 09. Share price is now $63, up from 28 and certainly up from even the 40. So as a shareholder, you've done better by that company staying public and not going, inside teachers' pension plan, never to be seen again, or maybe to be seen again at a higher level, right? They spun it back out. So that was the best example for me of, if you have a good business and it has good assets and a good competitive position longer term. And then look what BCE's done too. They did the deal with TELUS on the network sharing. They run fiber to everybody's home. They, the internet, if you would have told me, we could be doing this and we wouldn't be paying a phone bill for this 15 years ago, I would have said all the phone companies would be bankrupt, right? Like the way they've managed through a pretty amazing time, still profitably for shareholders, again, shows the value of good assets and a good network in place. And ultimately it's that network that sustains the company. And that doesn't matter whether it's, fiber optic network, bank branch network, pipeline network, and electric distribution. Like I try to buy networks for the base of the portfolio that kind of can't be displaced or have the ability to adapt over time to the different challenges we face as a society.
The Warren Buffett quote is, find a business that's so good that when an idiot eventually runs it, it doesn't matter. I think that's kind of the sentiment.
100%. Yeah, exactly.
The reason Newhaven exists is to earn a rate of return for investors. That's the point of the business. That's why we're all here. That's kind of the generator for the whole thing. In your opinion, what is a good rate of return? What do you base your business off of? Do you have a discount rate you compare yourself to? Like, for instance, the S&P 500. How do you think about that when you sell your business to clients and make your investments? Is there a number you kind of go off of?
Yeah, so that's a great question, because ultimately that is all that matters at the end of the day. And going back to the keys to the house example earlier, the thing is that number, especially in the early days for a client or for a business, can change, right? Like last year we were up 27% or something. So you spread that over the 4 years that we've been operating, performance, I think at the beginning of this year was like 10 annualized. Well, we've dropped, from our high point in March, we dropped, 10 or so percent from there. So that drops the annualized return back into the, 8 to 10% range, right? So that can move around early on for a client and early on for a business. Over time, that gets smoothed out into whatever your long-term rate of return is. And people always say, how long do I need to trust you for to know whether this is working or not? And I say, well, basically it needs to be almost 10 years. You need to go through at least one full business cycle and probably two before you can actually judge any portfolio manager on how sustainable their performance is, which most people are not willing to wait for, especially if it goes badly initially, right? So that makes it difficult. And so what I try to go back to with clients is, okay, well, what's the market giving us and why is it giving us that, right? So over the last 22 years, I'll ask you this question. What do you think has performed better in Canadian dollars since 2000, the S&P 500 or the TSX?
My high-level knowledge would say the S&P 500, but it sounds like that might not be right.
Yeah, so it's in Canadian dollars. No, it's the S&P 500 is slightly less than the TSX for the last 22 and a bit years. What do you think that number is annualized for both markets, just roughly over the last 22 years?
Well, I thought I read it was around 10, but maybe I'm wrong.
It's closer to 6 3/4 per year. And that's where it's interesting, right? So why has it been that low, right? That's low. Historically, market averages have been closer to 10, 11. Why has it been low? Well, it's been low for the last 22 years because we've had low inflation, low interest rates. And so the equity risk risk premium on any asset, real estate, anything, has been shrunken in by price increases. And we also came off a high in 2000. And 2000 is an interesting endpoint to pick or beginning point to pick. It's natural because of the millennial, but in the market cycle sense, assets have never been more overvalued than they were in 2000. Like if you look at anything versus trend on PEs, even this most recent bubble had nothing on 2000 in terms of how far things got away from trend. So given where interest rates were, because you still had 4, 5, 6% interest rates in 2000, whereas in 2021 you had 0% interest rates. So it made sense that valuations were that much more extended in 2021 versus 2000. So basically you have to look at it like, okay, what is my return assumption over and above the risk-free rate? Risk-free rate has gone from 0.25% to 3.75%, heading to 4 within the next, call it 3 to 6 months. To me, going forward from here, what I would tell clients is we should be earning kind of 4 to 6% above the risk-free rate of return. So that now equals 8 to 10%. Historically, when rates were, let's just call it 2 or less, I was saying it's going to be 6 to 8%. So 4 to 6% above. And that's where equity risk premiums have lived for a very long period of time. And that's why returns were higher 1970s, 80s, 90s than they were 2000s and 2010s and now into the 2020s. So we'll have to see where that ends up. There's also overlays on top of that. Like late 90s, we had this big boom because we had a big technology boom and the baby boom generation came into working age, plus women joined the workforce. And we had this big productivity, GDP, demographic, and technology boom that all happened kind of simultaneously. That's probably unlikely to repeat, especially given our demographics. Going forward, my view is demographics are crappy in North America. They're actually really crappy past into the 2030s and 40s in China because of the one-child policy and how that's really stunted their demographic growth. So to me, it's tougher times ahead. This inflationary thing we've got going on right now, I can see reasons why it will last based on just that we're out of cheap labor, we're out of cheap commodities in theory, and potentially that drives inflation going forward. But the demographics and the debt levels are so high that that's all very deflationary. So it'll be interesting to see how that interacts. So for clients, what do I say? I say, well, it's tough right now. At least now we can get some money risk-free. So, the range of returns actually, I think, has narrowed with interest rates being higher, but nominal doesn't matter. Like if you're only getting 6 to 8% in inflation, 6 to 8%, you're not actually making anything for clients. So what I would really like to see is a rate of return that's 2 to 4% above inflation long term. And again, that gets you into that 8 to 10% range. Hopefully if inflation settles 3 to 6, somewhere in there, and we'll just have to see. But so it's not a great answer and it depends on a lot of things. But right now, given where inflation is, I tell clients we need to be earning 8 to 10% for it to be justified to own this relative to, risk-free investment.
Which over a long time period is an incredibly hard thing to do every year.
But the thing is it's not, because the index does it, right? So it's for me, I'm not trying to deliver alpha versus the index necessarily. I think over time, a consistent strategy done properly should deliver, 100 to 200 basis points of alpha over and above the index. And I'm charging my clients 100 basis points. So I need to at least be generating that for it to be worth it. But what I'm actually trying to do is take the volatility out of the index and give them index-like performance, but with income, first of all. So again, you think of a client, let's say they've got $1 million and let's say they want $70,000 a year. So that's 7% of their portfolio per year, right? So in order to give them the 70, if you're generating 50 of it in dividend income, so a 5% dividend return, then you're only drawing 20 out of $1 million every year from the portfolio. And hopefully you're getting more than 20 in capital appreciation, but that capital appreciation is not reliable every year, right? It can come and go. It can be, you might get 70,000 of capital return one year. So now you're ahead of the game, but then you might get negative 100 one year, a 10% drawdown, a 15% drawdown. You're always drawing that 20 off the capital. And so over time, hopefully you're either staying flat or growing a bit, but you can also draw that portfolio down depending on the sequencing of the returns and how severe they are. And so for me, historically for my whole career, it's been, well, we can't get enough of that return in fixed income or risk-free assets. So we have to go to the market. And so how can we get to the market the safest way? Now we have to recalibrate that a bit now that risk-free rates are higher. I still don't think they're high enough relative to inflation, and I'm not sure they will get high enough relative to inflation to tip that scale in favor of owning a lot more bonds or guaranteed assets, but we're much closer, certainly much closer than we were a year ago. So again, that's the difference to me is trying to extract the return that gets the client from A to B so that they can just continue to live their life. Most of my clients aren't trying to like get rich off their investments in retirement. They just want to keep what they have, right? So how do I sustain that? And knowing that $70,000 or whatever they need per year is also going to grow at the rate of inflation. So the income better grow to offset that, and the portfolio better grow to offset that. So again, that's where hopefully an 8 to 10% return goal in this type of an environment is enough. But if we go back to 2% interest rates, then maybe it's again more like 5 to 7 or 6 to 8.
It sounds like a pretty honest explanation of the business model. One of the criticisms of asset management is that net fees, the mom and pop investor, is no better off than just investing in the S&P 500. But with dividends and a sharp eye on the markets, there is room for at least steady income, and maybe you get the capital appreciation that really makes the services worthwhile.
Yeah, so I've got a slide in my presentation, and it basically just goes through a Monte Carlo simulation. So a Monte Carlo simulation is just 10,000, it's using a computer for the listeners, 10,000 simulations of anything, right? So basically it simulates the possible pass for the market with an accepted level of volatility. So let's just say your average is 7, but in a more volatile strategy, your sequence of returns might be 7, 22, negative 30, plus 5, negative 4. And then in a lower volatility, let's just say a 10% volatility, it might be 7 plus 20, negative 24. So those range around the mean, the range around the 7 is thinner. And so then when you start simulating, okay, I've got $1 million portfolio, I want to draw 70 out of it per year, and you simulate it through all those different ranges, you see how many portfolios run out of money versus how many sustain themselves. And what you'll find is that the portfolio with the lower volatility level has a much better chance of getting to whatever your goal is. Let's just say it's 30 years of 70K a year, 60 to 90, 60 years old to 90 years old kind of a time frame. And so that to me puts weight in the fact that it's not just about all those portfolios have the exact same return. And if you're not taking $1 out of them, it doesn't matter which return path you take. They all come out to the same number at the end. They all start with the same number. But as soon as you start taking money out, it depends. When you're taking money out in a negative 24 versus a negative 32, you're taking more money out of capital. You have less capital then to recover and bring yourself back up. And that's where some of those portfolios with the extreme negative returns at the beginning of the return set will suffer. So think about someone that retired last year. Or let's just say they retired in 2020. Oh gosh, pandemic. Oh no, actually my portfolio is up 20%. I feel good. I'm spending at this level. Well, now I'm down 20 or 25 because I chased tech stocks and high yield bonds too hard. Well, that's going to hurt them a lot worse than my client that went, slightly negative in 20, positive in 21, and then again, flat in 22 with income to offset their spending need, right? So that's where the value comes in in my view, for my clients is, it's not about the annualized number. It's about how you deliver that annualized number, how consistently you deliver that annualized number in a market that's inconsistent. And again, we've been forced to own more volatile assets for people with less volatile goals because there hasn't been any return on fixed. And now that we're finally getting some, that's where we have to look at, if I see some, and again, there's tax consequences to, is the portfolio taxable because interest income is taxed differently than dividend income, et cetera, et cetera. So you have to measure registered portfolios differently from taxable portfolios. But if I see fixed income rates climbing, north of 5%, we're not quite there yet because the curve's very flat. Like, yeah, you can get almost 5% on a 1-year GIC, but you can't get that for any extended period of time. And then your risk is that they cut rates and the market runs, and then you're then left to reinvest that GIC in 1 year or 2 years or 3 years in a higher market and at a lower GIC rate because interest rates have fallen. So that's what I'm worried about for clients getting caught on that, like getting caught on fixed, especially if it's locked in fixed. So Yeah, like it's a very interesting time right now. And the types of questions you're asking is what everybody should be thinking about, but people go to like, am I beating the market or not?
One of the major value props for an asset management company is just to be a shepherd of capital and provide that stability. And not everyone is the next Warren Buffett with 20% annual compounding rate, but in some sense, you don't have to be.
Yeah, well, I look at it like Warren Buffett was fortunate in terms of the way the numbers added up to compound at that rate, because he basically started during the best period of prosperity and capitalism kind of we've had globally for a long period of time, right? And so the American dream, he always talks about the American dream, and people have said, no one's benefited from that more than he has, so he better believe it, right? And my view, again, coming in at a different period and maybe a darker, tougher period, not to say that there weren't tough times that he went through, and he's someone I put in very high esteem, not so much because of the numbers he's put up, but because of the way he did it. He did it in a way that was not egotistical, never took the short-term carrot, risking the long-term stability, always took a conservative path, and has had failures, and and again, nobody bats 1,000. Like I'm very willing to go through. It's a humbling pursuit. You can be wrong for a long period and then be right. You can just be flat wrong. You can be right initially and actually be wrong long-term. That's worse. So there's the judge of who's right. Goes back to what I said earlier, like only comes out in the fullness of time. And in the fullness of time, he's been proven to be a good steward of capital. But he used a lot of leverage through his insurance companies, compounded that in a good market, and had good opportunities in the types of businesses he wanted to buy where that worked, and has had more trouble in the last 20 years where the types of businesses he wanted to buy weren't the ones really kind of working for him, in terms of he's done well on Apple, but had some failures elsewhere, right? So I think he's like everyone, he's had a bit of a tougher time in this most recent period where I think the paradigm is shifting. And that's where for clients, I'm of the view that we really need to buckle down here. I think the capital is at risk. I think that things are, if not growing slowly, like at risk of shrinking due to demographics and just due to where the world is at now. I think that, returns, ultimately my thought is that returns will be lower. We'll go back to where we were 3 or 4 years ago, pre-stimulus, COVID stimulus, pre-inflation from that. I think we're more likely to return to that than see what we've got now going forward indefinitely. But again, can make the case either way. Going back to Buffett, like I really do think that he benefited from an unprecedented period of prosperity and did the right things during it. So it's kind of like a little bit of both.
A lot of your stock recommendations and picked have kind of been along the lines of the traditional business, utilities, energy, railroads, stuff like that. Did you see the value in those businesses in a particular way? What led you to those picks during the tech run up and all that? What led you to those picks? Was it value-oriented investing style, or was it the dividend security? What led you down that path?
Yeah, so it's funny, like value versus growth is really back in the lexicon of people thinking about investing again. I never really kind of put myself in that camp. I don't always view the stocks I buy as value, cheap. I think I try to buy good companies, and I don't really care what the price is if they're good enough to sustain the valuation that they're at. So I guess it's growth at a reasonable price or value at a reasonable price, however you want to put that. The thing that worried me during the tech run was the same thing that worried me about the bond market. It was like, if things change, then the valuations of these companies, through no fault of their own, will change dramatically. And we're pushing on a string in terms of how much more can we eke out of cheap credit and cheap interest rates to push, stock market valuations and bond market valuation. And so, because for my clients, again, I can't afford to have a 30% hole for my clients, even psychologically, like even if they could make it through, the math will still work out for them. We can't afford to be, 30% technology like the S&P 500 was and see it drop and I don't think we're done, by the way, on the valuation reset. We've had the valuation side of it. We haven't had, or the interest rate side of it. We haven't had what's going to result from the interest rates, which is to me a credit problem and an economic problem. But we'll see. Policy can change, and as we saw in 2020, can completely erase what would have been, I think, a catastrophe. So policy is important and powerful. But when it comes to why I choose the investments I choose, because they can get through something like that. And so we've seen that this year, right? And there's a bit of a kicker on that, where I do feel like the infrastructure side of the portfolio, especially the distribution utilities and power generation, I think that the need for power, especially in North America, is changing dramatically. For about 40 years, we had globalization, so offshoring of manufacturing production. So think about the power it would take to power all the factories that make all the things we consume. Those factories are now gone. Like, by and large, 80% of them, 70, whatever number you want to choose, a huge percentage of them are gone. They're in China. They're in places around China, Southeast Asia, places like that. So that's been decreasing our power demand as a society. We haven't had really any new use cases for technology other than computing, but computing has gotten so much more efficient every year that the growth in computing out there has been offset by the decrease in power usage. So you think about like mainframe, one-room computers down to personal computers, they just consume so much less power that the power demand from computing was rising slowly, but not at the rate that the amount of data flowing around was, the exponential growth that you would have seen in terms of data flowing around. And then you also had slow or reasonable demographic growth. So you had real estate growth offsetting that, right? So warehouses and residential and commercial and retail growing, big box stores, all that was consuming some power. And we didn't have any new use cases. So now what do we see going forward? I think we see a reshoring of manufacturing activity. You've already seen that with the CHIPS Act, and I've said this numerous times, but I'll say it again. I don't know whether Micron and Intel are going to make money on those chips that they make in Arizona and Texas and Ohio, but I know that those factories are going to consume some power. We're already dealing with a creaky power grid. So climate change is driving more air conditioning demand. So that's something that's really accelerated in the last 5 years. Now we have EVs. It's slow. I'm not one of these people that thinks, the horse driving into New York City in 1910 versus all the cars in New York City in 1927 or whatever that picture is. I don't think we're going to get that type of like snap your fingers change, but it is happening at the margin. So to me, power demand in North America, and we're still going to have residential real estate growth because we're underpopulated relative to other parts of the world. If we want to sustain our economy, we have to keep pushing demographics further. So to me, all those things line up to, at least in my lifetime, power demand potentially inflecting higher on this continent. And so when it inflects higher, you need infrastructure to support that. And so I like those businesses. I like them in the last 40 years where they were seeing, let's just say, a flat growth profile. But now you've had all that infrastructure age out for years. So you need reinvestment just to keep it whole, and then some growth on top of that. So I really like everything in the power stack, from generation, so nat gas, renewables, up to midstream pipelines, transportation. And that also goes for getting stuff offshore. LNG, especially LNG Canada, I think is a huge thing for our country, which should have been done 10 years ago. And then, out to the distribution utilities that are connecting all these new uses of power and need to get paid to do that work to make sure the infrastructure operates properly. So that's one area where, I'm positive on that from a theme-based or structural basis, but I also like the characteristics of the base businesses that they will get you through and see steady growth kind of no matter what, and will not fall victim to the valuation disconnect that you had based on interest rates.
Speaking of energy and power, it seems like the conflict in Ukraine has kind of reminded everyone of the importance of reliable energy. Or coming from out east in Toronto, are you seeing kind of a shift back to the appreciation of reliable energy and whatnot, or is it still kind of viewed as fossil fuels need to end?
Yeah, I laughed when you said that because I always feel bad when I talk to someone, especially from Alberta, about the stance we take politically here in Ontario. And it bothers me. And I'm not someone who is, let's go and just pilfer the planet and who cares, right? I try to reduce my consumption. I ride my bike to work. I'm someone who is extremely energy conscious in terms of but At the same time, I'm also conscious of the energy I use. I know what it takes to bathe my children. I know that the average person in North America expends more energy showering in a year than the average African uses for a whole year for everything. And that energy is also a sign of how our society is developed and why we are where we are. And so I think to completely ignore the fact that Alberta has provided reliable energy for not just this country, but this continent and now abroad, and to sort of just leave them, twisting in the wind for politically, it has been, to me, one of the biggest failures we've had as a country. It bothers me that more people who aren't exposed to it day to day just write it off as like, oh, well, I get all my power from Bruce Nuclear, so I'm fine, right? And who cares? I heat but it gets cold in the winter, so I use my furnace just like everyone else, and I drive my car just like everyone else. To me, again, everybody who's not changing their consumption habits is a complete kind of hypocrite. People that fly. I've been on a plane once in the last, part of that's COVID, but I don't fly unnecessarily. That's a huge greenhouse gas problem. Like a lot of people that do this, they go to Europe or the Caribbean or Florida multiple times a year. So I think that the criticism is incredibly hypocritical. It really bothers me. I think that, and I could go on. And the Biden administration is just as guilty of this. I mean, they're going hand in hand to Venezuela and Iran, trying to get the nuclear deals revived and trying to lessen sanctions on Venezuela. And they could have just built Keystone XL and had 800,000 barrels a day of very secure resource flowing to them if they needed it. So I think that I hope that this wakes people up. I hope that this changes. And Europe's been worse. I mean, let's not even get into Europe burning trees to keep the lights on before we talk about them restarting coal. We could go on and on here. But the big thing for me is I hope that there's a better appreciation for this. I really do think that natural gas, and especially Canadian natural gas is the greenest natural gas in the world because of our power grid's hydroelectricity load, and especially in BC, where a lot of that will be liquefied, and the shipping route to Asia is shorter as well. And even just the production facilities and fractionation facilities are more green in Alberta than certainly in the Gulf Coast of the US, where it's just hotter there. It takes more energy to cool the gas down, and they don't have hydro or good clean sources of power to do that. So Canadian natural gas is something I'm very positive on for the short, medium, and long term. And I hope that people wake up to getting something going from west to east again. That is something we should do just for our own security. You see the problems we're having with Line 5 in Michigan. That's a major infrastructure piece that supplies southwestern Ontario with refined product and propane for heating season. And the ability of one, rogue or one politically motivated, one politically motivated actor to disrupt that is something we should all wake up to. So again, I like those businesses, and long term, those are going to be the businesses that are adaptable to things like hydrogen and will be part of the energy solution long term. Those networks, again, just like the Bell fiber optic network I talked about earlier, have value into the future because they can be adapted and changed as the world changes and as the technology changes. So I hope that this is waking people up, but I fear that if it doesn't get bad enough, people will forget about it.
Well, like you, I'm a big skier and I love the outdoors and everything else along those lines. But what's unfortunate is the opaque environmental policies have actually backfired, where now you're getting more coal production and worse environmental records. It also leads into the case for the investment case for energy right now is those pressures on supply. So there's less supply coming on, and as a result, you're seeing higher prices, and the investment case is there for energy again. So have you thought of it that way?
100%. If you're a conservationist, or high oil prices are the answer. Like high oil prices and high energy price, we won't adapt unless we're forced to adapt, right? And so high energy prices also bring on more production, and it also allows so there's a balance there. I think that, again, if I look back on the last decade, what really happened, it was a financial markets problem. You had low amounts of good yielding fixed income in the United States, especially. And you had a technological boom in shale oil production and shale gas production that allowed for some very short-term business models to be funded at rates that they should not have been funded at. And it brought on a lot of production very quickly. And that was, ultimately that's a good thing in terms of energy security and also in terms of
for the consumer,
geopolitical, the consumer, but it's big for the consumer, right? It allowed a lot of prosperity in the last decade that wouldn't have otherwise happened because people had more money to spend on other things. But now I think that's over. But I just don't think that like shutting down the pipes or shutting down the oil companies and taxing them into oblivion, like it's going to have the opposite effect. It's going to have a reduced supply problem. People are going to be scrambling for energy, and they're going to be going back to, what they can get quickly and easily. And that's like biomass and coal right now, which is like appalling. I think if I look forward optimistically, what I think the most optimistic part of this thing is how nuclear is reacting and how people are reacting to, no pun intended, to that idea now versus how they would have reacted to it even 2 or 3 years ago. I think people are realizing that has to be part of the solution. You saw the big grant that OPG or the Ontario government or OPG, but working on a small modular reactor I believe it's at Darlington. And so things like that, I think are like a good outcome of this because we need balance to the load. Like if you look at what's happening in California the last few summers, like the hydro side down there, they've had so much drought that the hydro side isn't performing, and they've been forced to keep nat gas fired units, peakers on, and the other we can get into the whole thing, but the grids aren't connected, so you can't take power from one place to help out another place. Like all of that has to change and all that has to adapt. And again, that's why I'm positive on the whole value chain. Like I like renewables. We need more renewables. The more, the better, so long as they're developed economically and not causing their own problems in terms of like burying wind turbine blades and fields in Europe, etc. But we need all the solutions, and hopefully people wake up to the fact that we've actually got a great resource to supply the world in Western Canada, especially on the gas side in a reliable way. And even on the oil side, there's no other country in the world that has a common investment fund that the biggest companies put into to try to pool their resources to help with limiting their climate impact. And the climate progress they've made, even though it's still early days, has been pretty impressive. Like they're not trying to do it worse. If you don't ever talk to these companies and you just vilify them, to me, I think you're missing you're missing the point. And it's about, everybody just gets locked into their own lane, right? And they don't want to listen to other things. So we can go on, but I hope you're right. I hope that this changes the conversation. But the biggest change I see so far is on at least the attitude towards nuclear. But nuclear is a very long-term decision, and so there has to be. You can't change policy 5 years down the road and screw a capital investment that's supposed to be 50 to 100 years.
The argument coming from Calgary and the energy investors is that a stark misunderstanding, both federally, provincially in the US and Canada, is actually creating an investment opportunity because, like I said, the lack of investment in the industry is causing high oil prices, which is in turn creating great returns for energy companies right now. So I don't know if you thought of it that way. I'm sure you've seen some of the yields on the energy stocks are getting pretty high and everything else.
There's definitely a disconnect. And you're seeing, what I think has been most just very recently, I was actually just reading about this morning, like in the last 3 months, you've seen a 14% decline in WTI and a 12% incline in Canadian E&P stocks, which is very interesting, right? Like, so we're actually at the low end of the range for the past 12 months on oil prices, and we're at the high end of the range on share prices. So part of that disconnect is starting to be closed. That was basically the point of the note I was reading this morning, and I agree with that. It's still early days. Like the average investor, either fund portfolio, endowment fund, it's been, how can I get rid of energy? How can I get rid of energy? How can I take it out of the portfolio? And this was a process that went on from 2014 when oil crashed, and people said, well, I don't really need to own it anyways because It's not working anyways. So it's easy for me to stand behind all this other stuff and then tout myself as a manager or as a fund or as whatever that we've done this, right? And then that got kicked into overdrive in 2020 when oil prices went negative. Then it was like, we really don't need this. And then 2021, or even the rest of 2020, it was tech and everything was all that stuff. It wasn't working. So everybody was way, way, way out, probably as out as they've ever been on the space. Right. And then The signs were pointing up in the second half of 21 that we were starting to get shorter on energy supply as demand was coming back, and there hadn't been investment in the space for 10 years, and there are no offshore projects coming on, et cetera, et cetera, et cetera. And then it got kicked into high gear the other way, like right back into going from reverse to forward the other way when Putin invaded Ukraine. And so that, to me, again, I do agree that there's still a disconnect there. I'm surprised you haven't seen more private money, like private equity money, all these funds but I think everybody is still, there's some people begrudgingly coming back, clearly, generalists and larger funds that need the performance. Like I said, almost every, if there's one thing I've learned about this industry is that anybody who's moving money is a slave to short-term performance and a slave to relative performance. And that's why, again, running your own firm, you can stay out of that and hopefully just trend assets for your clients by not being, not having a boss that's saying, hey, why am I fourth quartile here? Pick it up. So that money might just flow back out as easily, but I do think still there's above average return prospects for the best businesses in that sector. What those businesses need to do in turn, though, is not get carried away like they did the last time and overinvest and promise things that they couldn't deliver and try to get short-term returns by juicing production numbers or juicing well results and all the crap that they pulled in the last cycle. Hopefully they've learned their lesson and frankly, they still don't have enough capital to really chase that hard. You're seeing that with rig counts, right? Rig counts are not exploding upwards. So I still think, I do think that there's an outsized opportunity there, but it's going to be choppy.
Is the perception coming outside of Calgary, Toronto, a lot of money managed there? Is it still that the energy industry is risk and that you're afraid of getting burned? And like you were saying, that production will go crazy and that they'll just blow a hole in the balance sheet. Does that still exist in the money management circles?
For sure. I mean, the scars run deep. The Crescent Point, the Penn West, and Canada, there was a bunch of them that, really burned a big chunk of the investor base here, myself being one of them. I'm very careful now with and that was when I was really learning about the industry and learning about the dynamics at play. And some of it wasn't their fault. I mean, when you look at what Saudi Arabia did in 2014, it was a pretty out there on the curve in terms of probabilities move that they did to try to shut U.S. shale down. But again, they were looking at it going like, this is uneconomic production. And if we push them on this, those business models are going to fail and we're going to have less competition. And ultimately, they had the balance sheet to withstand that, even though it was painful for them, right? So, but it was still out there on the curve in terms of like how abruptly they did it. So I can't fault management teams too badly when they had to pivot from a 110 barrel price environment to a $50 price environment, like literally overnight. But that's why, again, when you're managing a business like that, it was the conservative, smart, the C&Qs, the ARCs, the Tourmaline, those are the people that got through this, and the people that ran their business models too aggressively got burned badly, and people haven't come back. Crescent Point is, to me, I think even still probably one of the most undervalued stocks in the space, but people won't touch it, right? Because just other than the people that see the opportunity for that short term, every time that premium or discount will close, but people, long-term shareholders aren't going there. So not yet anyways. You might see it broaden out as time passes, and as it's hard to buy C&Q at 82, maybe you go down chain, but we'll see. There's definitely still some pretty deep scars. And people, and rightfully so. So that for as positive as I've been on, there were definitely some mistakes made, and those people need to be accountable for that.
Someone in managing a business in the energy sector would have that defense of the black swan in terms of price collapse. But if you're running a commodity business, I suppose it's incumbent on you to manage your business prudently and knowing that's probably going to happen eventually.
Exactly. And you got to be able to get through. But again, I go back and I feel sympathetic for them as well, because when you do have a 110 barrel oil environment, every investment meeting they're in is what's happening next quarter, how are we growing production, and you
so
start
hard.
listening to those actors, and it's the vocal minority. The average retiree holding Crescent Point isn't going in there saying, hey, I want 10% of my share price next quarter. What kind of well results are we looking at? Right. Mm-hmm. So, and because shares are traded at the margin, right? Only a fraction of a company's float is traded each day. And a lot of times it's the same actors trading amongst themselves, for weeks on end. The big moves come when, general money comes in, but at the meantime, the price gets set by a very small number of people. I don't mean to say it's manipulated. It's just the natural effect of how any stock trades. And so that's where you get into this, you start listening, like I said, to the vocal minority. And it really that's where you have to go, in my view, the only way I've found to, and not that I'm the best at it or not that I, have a perfect track record of doing it, is go and look and see, do you believe in this or not? Like when I ask you this question, how do you react? And for a long time, I met, and I don't mean to keep dragging Crescent Planet, I don't want to be seen, but I really like Scott Saxberg. I thought he was a really smart guy. They did a lot of stuff for that company. The reason it's still alive today is because they did things the right way. They're a good operator. They complete wells in a more expensive way so that they can then go back and refract them if needed. They do all the enhanced oil recovery stuff. They don't, it's not just blow a hole in the ground, get it out of the ground, move on. They really do. They really did do a good job, but their capital market strategy was terrible. They pushed it way too far, too fast. And it didn't work, with what happened. And so in the same way, you have to be accountable to that. And have the discipline to let things go by you and say, yep, that's fine. They can do that. Other companies can do it. Our share price will lag, but we're going to keep investors whole for the long term. And so I've gotten better at figuring out who those people are. Not to say it's perfect, but it's something that's much more factored into my process than it would have been, 10 years ago.
It seems like the best capital allocators are still around. Survival of the fittest in a way, like the Tourmalines and the CNQ.
Yeah, for sure. Yeah. I mean, definitely an evolutionary Darwinian separation over the last, certainly, and even, 2020 was very ugly too. So, but luckily the ones that had survived were prepared for that by the time I came, right? Mm-hmm. Whereas in the States, it blew up a lot of those last models in the States because they were forced to go through the starvation period that we were, with differentials blown out and the oil price down and Canadian dollar getting trounced as well.
Are you seeing any renewed interest out east in the energy sector a little bit more now? I mean, there's definitely a hesitation, like you said, but is it picking up at all?
I mean, it must be, right? I mean, that money doesn't come from nowhere, right? So I don't have as many, COVID's really changed the amount of interaction I have with peers, which is a bad thing. Used to go to investor meetings, and also moving to a smaller company. When I worked in a bigger company and ran a larger fund, it can be good and bad. But one thing I do miss is sort of just hearing what other people are thinking. I also think there's a lot of people quietly putting money back in. I don't think people are talking about it. But if I look at the energy infrastructure conference I went to recently, it was more, and again, that was renewable companies, distribution utilities, and midstream oil and gas pipeline companies. The attendance was pretty solid. So I do think there's renewed, and again, it's because it's working, right?
Yeah.
I mean, my view is I will always own it because I think it's a base need, and it's part of my long-term view of we're going to need energy, and Canada has politically secure, geologically sound energy that can be produced at a good price level for the world and for our country and for our continent. So that's going to be a part of, but other people will come and go, right? So that's just what makes a market.
Cryptocurrencies. You avoided crypto. In your opinion, why did you avoid crypto, and why is it collapsing now? What was it, an investment opportunity that you missed, or was it pure speculation? What kept you away from crypto?
So it's one of the first meetings I had with my current partner. This was in 2018, the first time Bitcoin went to, I think it was the first time it went to 20,000. And I remember saying yeah, I'm ready to move over, but who cares? We should just throw it all in Bitcoin anyway. So I was right. And he challenged me. He said, I don't know about Bitcoin. And this was when it was only Bitcoin. I mean, Bitcoin kind of spawned this ecosystem in the last, since that time, right? I mean, Ethereum was there, but other than that, the rest of it hadn't developed. So anyways, he was like, well, I'm not sure about Bitcoin and the tokens or whatever, but the blockchain has, and I'm thinking, this guy's almost, he's in his 60s and he's actually reading up on it. Like I should take my head out of the sand, because I was just of the view that, hey, this doesn't work. It's, it's bogus, it's fictitious, etc. So since that time, I've done a lot of reading and a lot of work on that. There's great people on financial Twitter that I really have come to respect. And there's been another PM in the industry who's sort of he's a little bit younger than me, who's turned me on to a few people that I now find very valuable in terms of their thought process on a day-to-day basis. And not that I take their ideas, I still practicing the same strategy I was taught, but at least it gives me a better view of the world and a better understanding of what's going on in the world versus just saying, I don't want to know about it. So cryptocurrencies, why stay away from them? So stayed away from them because in general, there was no assurance that there was a use case for the end value. And the issuance was not regimented. This is separate from Bitcoin. And so, it was basically a pure speculation thing. And to me, it was such a foreign environment in 2019, 2021 to see capital kind of just flow towards anything that moved. Like I'd never seen that in my career. I said, like, this must have been what it was like in 1998, 99, 2000, right? Like this is what I heard about, but I never thought it would happen again because everything got, that 2008, 2009 was the worst drop in asset prices and the economy since 1929. So I basically looked at like, hey, I lived through the big one. Like we're not going back there for quite some time. And it happened quicker than I would have thought. And it was weird. I do believe in Bitcoin. I own some Bitcoin personally in a cold wallet. I think that the supply demand dynamics of the protocol are different than most other cryptocurrencies in terms of the issuance protocol, it having the amount of coins that are issued. The thing that it relies on, though, is the computing power needed and the proof of work network to validate all the transactions. Again, I'm a bit out of my depth in terms of my complete understanding of this, but Bitcoin is the one decentralized network that I think has store of value characteristics that are needed, and especially in certain places in the world. Like it's very nice for us in North America to say, well, we can put our money in a bank account. Like a lot of places you can't do that, right? Like, because you're either at risk of being devalued or confiscated or both, right? So a good example is like in certain places of the world, like if you were in India and you sell your house and you want to live abroad and then you want to go back 3 years later and buy the same house, like where do you put that money in the meantime? And someone posed this on Twitter, and a lot of people who live in these areas were saying, I buy used cars, I buy gold. So Bitcoin has a use case there in terms of store of value, but now it's been set back by the crypto ecosystem that was kind of piggybacking off of the Bitcoin frenzy that happened in 2016, 17, 18, that sort of was this industry created of nothing that does nothing for no one other than the people that are in the industry, right? And so I'm not surprised to see it taken apart the way it has been. I think there's probably more to come there. I also think it's a harbinger for private equity. When you look at all the money that went into all these private equity funds over the last decade as well, because we want uncorrelated returns and we don't want to have to see our fund value floating every day on the market, and we want less transparency around fees because now they're going after transparency on mutual fund fees, etc. So all this money flowed into all these private equity products, and some of them good, some of them bad. Like I'm not saying like everybody who does private equity, like there are a lot of really great, like Brookfield Asset Management, Carlisle, like there are obviously teachers, like there's lots of people who do private equity really well, but in any event, the whole pool of capital got so large, there's only so many good deals in that space. And you've seen, Sequoia and a few others been wrapped up in this FTX thing, teachers. And so it stands to reason that industry was also built on a lot of cheap debt. How are they getting their returns, and how were they charging so many fees to people while they were levering up everything they bought as well with cheap financing? Because why would they not? So I think that's something to watch in 2023 is the private equity space. Crypto is kind of like, to me, a canary in the coal mine of like, because that's going to flow back up to the private equity space. And the other thing about crypto that I wanted to say that I kind of lost my place on was you were always converting it back to real dollars. So to me, even with Bitcoin, it was like, okay, Bitcoin's worth $20,000. Okay, well, and it's worth something in dollars, right? So like until it's its own thing, right, where it's not just being converted back to another unit of exchange, like until it's the unit of exchange people are using in a broader way, to me, it's only use cases that kind of store a value thing. But that's still a good enough use case to me that it has some sort of future, because it can't be disrupted by one actor centralizing it and blowing up his portion of it relative to everything else and causing a bunch of collateral. Like basically we're in a collateral debt spiral right now, right? Where it's like this person owes this person. Guess what? This person's bankrupt. They can't pay you. Well, what about the money I owe the next person? Well, this person can't pay me, so I can't pay you, right? So it gets into that spiral, and that's where we're at right now. But let's see if it goes into the private equity space. And I think the private equity space is at risk just generally on the economy and just regular, not just cryptocurrency. I'm not saying cryptocurrency businesses are going to bring down private equity. I'm saying that it's an interesting first window into some of the investments they've made, and think about all the other investments they've made over the last 10 years that have been done at low interest rates with marginal rates of return, that now in a tougher economy, if we get a tougher economy, and especially the real estate side of it, let's see what happens, because look how much real estate investments are down this year, right? So let's see what happens when those mark-to-markets start to come and those loans start to have to either be rolled over or come due. I'm that's one thing I'm really, it might not be anything, but because we don't have visibility into it, that always makes me nervous. It's very much the same as the subprime thing in 08, 09. I think there's a private equity bubble that was out there that now might be under some stress.
Possibly opportunities for someone like yourself in Newhaven.
Well, I mean, there was a long period of time where businesses of a certain size either didn't come public or were gobbled up from the public market into the private market, right? And one of the companies I really liked and owned was Enercare. It got bought by Brookfield. So I still own it in a roundabout way by owning Brookfield Infrastructure, which was the part of Brookfield that bought it. But I would have rather owned that business, on its own. And Interpipeline was another one, right? Got bought by Brookfield, which I owned outside of that as well. And so you're seeing, now I get a diluted exposure through Brookfield, but I don't have exposure to those specific assets that I like. And I remember like the Enercare one, there was a lot of people saying, oh, why are they buying this? And then the next year it was on the cut, like it was like their big success story in their investor presentation, but we bought this business and look what we're doing with it. And it was all things that, because I believed in the company and knew about it initially, was really positive on. And like, again, going back to the teachers buying BC example, like that's why they bought it, right? Was to make with it. So yeah, potentially there will be some opportunities where some stuff comes public at better prices. And just like the fixed income markets come available for us for the first time in a decade and a half, maybe the IPO market will as well.
In summary, you're a little nervous. Maybe some dark clouds hanging over the economy right now.
It all depends on policy. But it all depends on what happens with central banks and interest rates. And it has depended on that since we went into quantitative easing in 2012. It's been, are we buying bonds and pushing interest rates down? Then it's good for asset prices. Are we not? It's bad for asset prices. We had the first little flutter in 2018 when we started increasing rates and started quantitative tightening. They reversed course on interest rates because they were able to, because inflation was low by February 2019, I think. And the market was off to the races in 19. And then 20 was a really weird year. 21 was kind of a hangover. And now we're maybe not a hangover. Maybe it was like the after party. And now we're kind of in the, potentially the hangover phase. And we'll see how long it lasts and how long it's allowed to last. So yeah, I don't know. Like we'll have to see. I'm definitely nervous on the economy and the housing market. I think that this monetary policy acts with a lag. So the longer rates stay up here, the more loans get refinanced, the more mortgages get refinanced, the more that crimps people's spending. People had already binged on durable goods anyway, so they got less to buy anyways. Energy prices are high, food prices are high, all of that. To me, I just don't see how the consumer saves the day here. And that's always where we go back to in North America, is how we can get the consumer to save the day. But, we decrease interest rates again, things change on a dime. So we'll see if that happens or if that's allowed to happen. And you see it in the market, right? Every time we get close to a good inflation number, which I don't know how 6% can be viewed as a good inflation number, or 7%, whatever the last print was. But the market likes that, right? So we'll see. But I am sticking with conservative infrastructure investments with decent dividend yields and not much else.
That's a really good conversation. Like I said, I know you don't have all day. Maybe if you were to leave the listener with some advice on how to navigate waters going forward, what would you tell them?
I would tell and this is what I tell all my clients, is that if you don't sort of understand at least some of this yourself, you're at risk of being led off course by either your own emotions or someone else's. So try to do what makes sense to you, not what makes sense to someone else.
Keep some money in the bank.
Yeah. And now for the first time literally in my career or since the very beginning of my career, savers actually have some power. You can actually put money into a bank account or a GIC and actually compound that money at a reasonable rate. Mm-hmm. So I mentioned the reinvestment risk position we had earlier. But until that happens, the reinvestment risk meaning like you lock into a 1-year GIC, they cut rates, market's up 20%. Now you're forced to reinvest that GIC at 3%, let's just say. That's the bad scenario, but I don't see that happening in the very short term. So for now, I think stay conservative, put money to work. But I think, again, when you're evaluating a 5% GIC or I don't know, just to pick a company like Pembina Pipeline or AltaGas with a 4 or 5% dividend yield with a future, I think it behooves you to at least have some of your money put to work in those spaces where you can feel good about it. And if the business makes sense to you and it's sustainable to you, then and the manager you're working with is focused on those types of businesses or that type of portfolio, then to me, that's going to be your best chance, I think, of compounding capital at a rate that is acceptable to your goals for the foreseeable future. And it's kind of one day at a time, and you don't have to do everything overnight and just kind of try to stay steady through it. But I think there's going to be a lot more. It's been a pretty difficult 5 years to navigate ups and downs. And it's been a pretty difficult decade and a half, I would say, for I think this has been a more difficult investment environment than, say, I don't know, it's hard to say. The 80s and 90s had their own challenges. Every environment has its challenges. I shouldn't say I'm hard done by, but eyes on the horizon, not on the waves. That's kind of, try to stay long term, and fewer and fewer people have the ability to. But if it's your money, you do have the ability to look out 10, 20. You're not a slave to short term performance. So buy what makes sense to you.
Well, that's awesome. Thank you very much for your time. It's great to hear your thoughts on Newhaven, investing, and everything else. So,
yeah, I appreciate it. I've enjoyed the conversation. Really good questions and thought-provoking, thought process from your side. I can tell you think about this a lot too, and just by the questions you ask, like those are the right things to be focused on. So hopefully this has use for somebody out there, and would be happy to do it anytime.
Thanks for listening, everyone. Hopefully you enjoyed the episode. If you liked what you heard, check out rosebros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.